go ahead and stay in our normal order and do things the way we always do, and then I'll talk to y'all for a minute, and we'll get into the lesson. So let's let's go to you, Doctor. Well, no, let's stay in order. Go to Barbara first, okay? Over to you, Barbara.
Yes, sir. Here's our disclaimer for futures and commodities trading group. Trading and investing carries a high level of risk. You could lose some or all of your investment. Trading commodities or any other financial instrument may not be suitable for all investors. Before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. We accept no liability for any losses or damages you may incur. This means that you alone are responsible for your actions in any trading or investing activities.
Thank you so much, Barbara. We always have to make sure we take care of that. And then next, we always make sure we go to Dr. Melville because she does such a wonderful job of going over any quizzes we had throughout the week. But in this particular case, I think we had 2 weeks of quizzes. Am I right, Dr. Melville?
So I have starting on the 31st of March.
Okay.
Yes, if I'm not mistaken. Maybe a little bit further back, huh?
Yeah, I think we had 2 weeks worth this time.
Yeah, you're right, sir. You are correct. I stand corrected. So, okay, the first one is when the market is trading up and reaches an area that is having trouble trading through, what is this trouble area known as? A glitch, B, resistance, C, support, D, waves, E, not sure. When the market is trading up and reaches an area that is having trouble trading through, what is this trouble area known as? And I see some answers in the chat. Resistance. Tanya saying resistance. Resistance from Lucky. Resistance from Ezra. Resistance from Jamal. Resistance from Paula. Okay. Resistance have it. B, resistance. The next question is, when you're trading in the futures market, you have the margin and you have the maintenance in your account. What do we use to substitute these two words? A, minimum and maximum, premium and price, deposit and balance, not sure, none of the above, all of the above. I have a C by Jamal, which is deposit and balance. Franklin, Paula, deposit and balance. Anything different from anyone else? Okay, deposit and balance has it. Good job, you guys. Wow. We got some sharpshooters tonight, Delvin. Okay, the next quiz question. Can support become resistance and resistance become support at some point? No, yes, not sure. Can support become resistance?
Yes.
And resistance become support at some point?
Yep.
Okay, we have yeses. Excellent, excellent.
And they've been paying attention.
Yes, they have. Now, this one stunted me. I said, did I miss this class for this question? One of the commodities that traded in the futures market was banned from the market. Which commodity was banned from trading? A, pork bellies, B, the dollar, C, onion, D, lumber, E, cheese, F, not sure, G, none of the above, H, all of the above. Everybody has onions.
Onions.
So Lucky has dollar.
Onions.
Rashid says onions.
Onions.
Okay. So the onions have it. Yeah, I had to
Yeah.
look this up. The onions have it.
Yeah, we talked about this before,
Okay.
and it's interesting, to talk about it because it's never happened before until it happened, with onion. And why did the market, why did onion get banned? It, you know, there was a gentleman who almost cornered the onion market, and I forget his name. I know it, but it slips my mind right now. But onions was banned from trading the futures market because the president passed the Onion Act, banning the trading of onions. You said you looked this up, Dr. Mel?
Yeah.
Yeah, you read about it, right?
Yeah. I was like, wow.
Mm-hmm.
Mm.
Onions used to trade in the futures market, and because of what he did, that act was passed, and onions was banned from trading. I'm gonna tell you the interesting thing about it. I posted that question. I love when people from the room call me throughout the week and ask me some interesting questions and stuff. It keeps me on my toes too. But the question threw me because I didn't know the answer. But the person called me about this quiz and said, well, when y'all talk about the purpose of the market, you talk about the market, what it does to help prices. And these commodities trade in this market, and that helps the prices. So since the onions can't trade in the market, what keeps the onion prices from being created? And I don't know. Great question. Matter of fact, let me see if I can pass it. Is this something you know the answer to, Josh? Because I don't. Yeah, that's an excellent question. I don't know, but it was banned from trading, but the prices of onions are able to, be stable, right? But without it being traded in the futures market, what is being utilized to do that? Excellent question, and I have no idea. But
Mm.
yeah, it's something to ponder, though, right?
Hey,
Yes,
Devin.
that's it.
Hey, Josh.
Hey, so I also don't know the definite answer to that. But my guess is just a regular free trade, free market would keep that in balance.
Okay, okay, appreciate that. Yeah,
Yeah.
yeah, that was a good one on me. I didn't know. So, what I wanted to talk to you all about, appreciate that, Josh. Before we jump into the lesson,
There's one more.
oh, okay. I'm sorry. Let's go. Keep it
Yep.
going, Dr. Miller.
So the next quiz question, you don't need a brokerage account in order to trade futures, true or false?
False.
False. You most definitely need a broker. You can't trade without one.
Need one. Yeah.
Very good. All right, that's it. Back to
Yeah.
you,
At
Mr.
least you can't. At least you can't legally.
Yeah, I know, really.
Yeah. Yeah. Make sure we really understand that we trade within a regulated market, and the only people who are able to buy and sell these futures contract to us are people who carry and hold a proper license to do that. And that's why we have to open an account with one of these licensed brokerage houses because we can't do that without going through a licensed brokerage house. So yeah, we we have to open an account through a brokerage house. We can't well let me ask you, I got a trade right now and I'm trading in the SOFR market. And if I want to get out this trade today, this evening, and if Dr. Mel was looking to get into the SOFR market, can I sell my futures contract to Dr. Mel since she's looking to buy one?
No,
No?
No, not without the broker.
Not without the broker. Anybody think I can? Anybody say yes, I can?
I did.
Yeah. So I don't have the license to do that. So it will have to be done through a broker. I can't
Hey,
sell my
Dalvin.
contract. Yeah.
Um,
Go ahead, John.
Unregulated individuals don't have the ability to do that, like you said, but people in the industry do trade with each other all the time without the
Yeah,
use of a broker.
that's right. Yeah, they can do that even with deliveries, but people like me couldn't. So
So
here's what I want to talk to y'all about. Something that was on my heart because I know we got a lesson to get into, but I think this is a whole nother lesson in itself. Um, we we have a lesson coming up where we're gonna get into talking about the market trading down and what that looks like, and the fact that money can be made even when that's happening. Okay, but I was made aware. Let me say this first. The only market I watch and pay attention to is the futures market. Uh, I'm not really, zoomed in and up to speed on what's going on with the stock market. But I was made aware that um, from somebody that in the last couple of days, there was trillions of dollars uh, traded to the downside in the stock market. And the way it was presented to me is that it was said and told that there was trillions of dollars lost in the last couple of days in the market. And it was actually said, yeah, that these trillions of dollars was wiped out. It was wiped away in 2 days, in a couple of days. And I wanted to just stop and talk about that for a minute. And let me ask the question before I say what I'm gonna say. Is there anyone is there anyone that thinks that trillions of dollars was wiped away in the stock market in the last couple of days?
repeat that question, please.
Is there anyone that thinks that there were trillions of dollars that was wiped away in the stock market in the last couple of days?
Yeah.
So when it was wiped away in the last couple of days, did it just vanish into thin air? When it was wiped away, what is it that you think happened to it?
Money never
It
disappears,
was
it only moves.
Say it again. Say it again, Mr. Reed.
Money never disappears, it only changes hands.
Exactly.
I was
Exactly.
just gonna say that. It was moved. Yep.
Yeah. So yes, I want to make sure we understand that trillions of dollars was not wiped away. Okay. There were people, yeah, that probably sold. There were people that were panicking, probably sold, got out of the market. But trillions of dollars wasn't wiped away and vanished into thin air. If the market traded down, funny, I've had this conversation with my broker before, and he said, "Man, I wish, I wish we could get you on speaker to say that." But the thing is, I don't think when people are reporting and putting this information out that they mean it in the wrong way to misinform people. They are just doing their job. But let me say this: if you needed some dental work, if you needed your mouth work on, would you want somebody to do your dental work that didn't know what they were doing, that didn't have the qualifications to do it, never done
No,
it before?
no, sir.
No, sir, you will not. And it's the same thing. A lot of times we have people who are just doing their job and they're reporting what they're supposed to report, but they have no clue about the information themselves. And this is what I've been talking about for years when I tell you all that people feel that when the market trades down, every single person that's in the market is experiencing a loss. This is what people think. Several people on our call have unmuted and said that that's what they thought too, because that's what we've been taught. When the market down is bad, everybody's losing. People go to posting on Facebook, hey, you better go check your 401k. They think everybody that's in the market is losing their money right now. And I'm telling you guys, I need to find the words that make everybody understand this is not true. Call your broker if you don't believe me. Everybody's not losing their money when the market goes down. Do anybody know who's losing when the market goes down? We're going to talk about two animals. I want y'all to use that when you answer the question. When the market goes down, who's losing?
The Bears.
Bearish.
The Bulls.
Yeah.
The
No, when the
bulls.
market goes down, the bullish.
The Bulls.
The
The
bulls
Bulls.
are the one that's
But-
losing. But are the bears losing money when the market go down?
High possibility.
No.
The bears
No.
are trading the market down, right?
Right.
It's trading it
Yes.
down.
Yeah.
Everybody's not losing money when the market goes down, no matter what you may hear or see in the in media. I trade the market down all the time, guys. We can make money when the market goes down. The media wants you to think that everybody loses money when the market goes down. If that's the case, we would just have bulls. We would never have bears. We have to have the understanding that the market trades in both directions. The bulls are trying to take the bears' money, and the bears are trying to take the bulls' money. When the market goes up, the bulls are winning. When the market goes down, the bears are winning. Okay? Everybody needs to understand that. So the money is just not wiped away and vanishes into thin air, like Mr. Reed said. It's just changing hands. It's changing animals. And I want to make sure we all understand that, because we've been programmed to think differently.
Can I?
The system and the course we teach, we all know we teach and learn in this course how to make money when the market goes down. So I want everybody to make sure we clear on that. Money doesn't just vanish out of the market and disappear. Okay? Make sure we understand that. I know.
This topic up because this was something that I've been very concerned about all week, that, or here recently, that ever since we changed administration, we got a 1, 2, 3 top and it changed direction. But if you don't mind me throwing my sense of humor in here, since you guys surely missed it, to stay on the dentist analogy, Dr. Melba, when the dentist pulls all your teeth, did you lose all your teeth or did you gain dentures? I'm sorry.
You gain dentures.
So is the denture the bear or the bull? I'm sorry, I couldn't help it. Oh, and just to let you know real quickly, it was President Ford that did the Onion Act, and it was done because it was believed that the onions is a perishable commodity, which we can't stand the futures portion.
Nice. Thank you, Johnny. Yeah, I did remember it was Ford, but yeah, appreciate you explaining that, because it was something that's never happened before. But yeah, we never want to do what he did. You don't want to try to corner the market. He almost did too. Yeah, that caused that. Great. All right. So I just wanted to talk about that. I appreciate y'all letting me get that off my chest again. I know you probably heard me say it over and over, but since it just something that just actually happened in the market, I want to talk on it, just touch on it again.
Can I? Okay.
Okay, you want to say something before we jump? Let's go ahead. We're gonna get into the
Yeah,
lesson.
real
What you
quick.
want
I'm
to
gonna
say,
try
Jamal?
to make it a minute. Try to make it real quick. When you are going to a play, this is a analogy. When you go into a play, you got upstage and backstage. When you said what you just said, Delvin, a lot of things is what's happening backstage. You see what I'm saying? So when you ask, is it being transferred or is it crashing or whatever the case may be, it's what's going on backstage. Upstage always looks good. It's always entertaining. You understand? So when you go backstage is where the hard workers are for real. So
Yeah,
so to that piece, when you start talking about is it being um transferred or is it crashing? Because crashing is what I got. It's being transferred, and that's the part that people don't see. It's that part that you don't see. It's backstage. Upstage is always glamorous, always, because you sitting out in the audience watching the show, but you can't see past the curtain for backstage. You understand what I'm saying? And that's when the finagling and all of that. Just like the Wiz. It was Toto that went behind the curtain and found a man that was calling all that camaraderie, and he wasn't nothing but a feeble man, causing a
mhm.
whole bunch of stuff. You understand what I'm saying? So I just wanted to drop that in real quick. I didn't want to take up too much time. Yes, sir. Yeah.
Nah, great stuff, man. I appreciate it. Yeah, it was just on my heart when I got the call about it, and about this. Um, I had to explain to my auntie what we're, you know, what I kind of talked to you all about. And the most important thing is I just want y'all to just, I just want you to take away from what I'm saying is that there were some people that made money in the last couple of days in the stock market. That's all my point is really saying. I want you to know that there were some people who made money during this $1 trillion that was wiped out. And 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 these people were probably going short the market or trade the market to the downside. And see, this is something we learned in our class and our, in our lessons. So I just wanted to make sure we understood it because it's something that we constantly keep being told. And it goes, so many times of hearing something, it start to go into your mind. What?
Delvin, it's probably the most important thing we teach here.
Yeah, and it's the most important thing we have to focus on trying to help people understand, right? How many times have we had to keep going over that because it's something that we're trying to unprogram where they've been programmed to understand. So I've heard all my life that the market is not good when it's down, and then y'all telling me we can make money when it's going down. And yeah, it takes a minute for that concept to be something we understand. So get excited about the fact that we can do it, and we're gonna teach you, and you're gonna learn how to do it if you want to. Josh always makes the point that a person can trade their whole journey, their whole career, and never trade the market to the downside if they choose not to. It's up to you. Let's say you don't understand it or you just don't want to. You don't have to. But if you do, that opportunity is there to trade the market both directions. So just know trillions of dollars wasn't wiped out. It just vanished and it's gone. Mr. Reed made it real clear to you. Money doesn't disappear. If a business or organization or industry lost that type of money, you know, it'd be hard to stay in business. You lost trillions of dollars. I heard it was close to 10 trillion. I don't know. Like I said, I just went by what I was told. But I did see people making posters about it on Facebook. So let's get into our lesson, Barbara. Um, and I appreciate y'all letting me talk about that. Thank you for the input, Josh and Jamal and Johnny. Appreciate that. So lesson 6, where we at? Well, we ended up having to go over 5 make lesson 5 2 parts, right? We had a part 1 and part 2 because we had so much to go over in lesson 5. But in lesson 5, we talked about support and resistance. Dr. Member did a great job explaining to us about the fact that we have areas on the chart that are trouble areas. And when the market reaches and trades to these areas, this is considered an area where it may have some trouble. And depending on which direction it's trading, it will be called support or it may be called resistance. And we talked about the fact that we watch for certain things that happen on these charts. There are certain things that take place and form as the market is moving, as the market is trading, and we watch for these things. But to make it real clear and simple to you, we are not watching for a lot of things when it comes to the way we trade, guys. We're only watching for 3 things on these charts, okay? Just 3. So we're not watching for 15, 20 different things. It's just 3 things we're looking for on the chart. And there are formations that form on these charts, okay? And these formations that we're looking for on the charts, what they really are the things that we just went over last week. They are support and resistance levels on the chart. That's what these formations are. And we're going to get into looking at what that is, what it is that we're talking about. But these formations are nothing other than support and resistance level, okay? And there's 3 of them that we watch for. And I can see we also going to talk about something that happens on the chart. It's called gaps on the chart. Sometimes gaps show up on charts when you're looking at them. You see, okay, well, why is that big gap there? Let's talk about why that big gap shows up on charts sometimes. We'll get into that in this lesson. And then we have a video that we like to look at that gives another perspective and talks about and shows us some example of how the formations we look at, we watch for how they work and take place. So we'll go over the formation, then a little later we'll watch the video that kind of explains and goes into the formations as well. All right. What are our 3 formations? Y'all, you know what? I'm so glad to have this face back on here. I want to ask if he wants to talk and lead us off with this or not. Johnny B, are you filling up to it, my friend? If you're not, I got it.
I'll play as long as I can.
Okay.
Yeah.
Well, take this, get us started here, my friend.
All right. I mentioned this a few minutes ago when I was trying to make a joke, but we have 3 tops, or excuse me, 3 formations we look for. We look for a 1, 2, 3 top, a 1, 2, 3 bottom, and a sideways channel. And right now, I don't care pretty much what market you look at. There is a beautiful example of this. You know, I mentioned that, you know, we had a change in election. And the point I want to make to this real quick is I specifically don't want to talk about politics. I want to talk about if you didn't have the radio on or the TV on and you never listened to the news about the election or, you know, who was going to do what for what, if you just watch the charts, you would currently be in a right position to be playing the market. Okay, so we have a 1, 2, 3 top, 1, 2, 3 bottom, and a sideways channel, and we want to cover those. So next slide. Okay, a 1, 2, 3 top, or the top formation, occurs when the highest price is achieved on the chart and the market changes a direction to the downside. okay? In what's known as a downtrend. But how do we know it's really, just because the market turns down, how do we know that's true or not true? So we're looking for a 1 and a 3, which are resistance, and number 2 is support. Okay, that's what we're looking for on the chart. Next slide. So let's talk about the 1, 2, 3 top. The number 2 represents a level of support. Okay, the number 2 is the most important part in that formation. Most important part in that formation. And it's because it's going to serve as our entry point. Okay, now we're going to explain that here in a second. The number 2 forms on the chart when the market changes direction to the downside, it hits support and goes back up to retest the number 1. But if it fails to retest the number 1, okay, that forms a number 3, and then the market goes back down, back to support, back to that number 2. We know it's confirmed if that number 2 doesn't hold. All right. So if it falls below that number 2 and creates a new support, and then goes back to the number 3 to test the number 3, that will start to confirm our 1, 2, 3 top. So the number 3 is going to be the new resistance. The number 1 was the original resistance. The number 3 is the new resistance. Okay. Is that clear for everybody? So we hit the top of the chart with a number 1. It causes resistance. It goes back to the number 2, which is support. It holds and goes back to form a number 3 if the number 3 does not break the old support, the old resistance of the number 1. All right. Now, in order to create a trend, then what's going to happen is we're going to have a series of lower number 2s and lower number 3s. Lower number 2, lower number 3, lower number 2, lower number 3. And when that happens 3 times, it will confirm a downtrend or a new trend in the opposite direction. I hope that's clear. So here's a very good example. So the high on the chart is December corn. The high on this chart is the number 1. It changes direction, goes to the number 2, which forms support, goes back to the number 3. But the number 3 does not surpass the old number 1. If it did, it would create a new number 1. And we would start all over. Okay? So we get a number 1, a number 2, a number 3. The number 3 fails to continue and goes back to number 2 and creates a new lower number 2 or a new area of support. Okay. It changes direction again, goes back and forms a new number 3, but that number 3 again is lower than the previous. It breaks, it holds resistance. It goes back and creates a new number 2. And so on, and so on, and so on, until we reach the bottom of the chart. When it reaches the bottom and we get a new low, then it will create a 1, 2, 3 bottom. All right. So next, any questions up to this point?
I am confused, but I will be unconfused real soon. But it's all right because
Yeah.
I'm wise. It's all right. It's all right.
Yeah, we're gonna do it. We're gonna do it over again. And as Mr. Johnny is talking us through it, Barbara's gonna point out the 1, 2s, and 3s and trace it through for him. Or somebody's gonna trace it through. Thank you.
Yes, ma'am, Dr. Melville. Thank you.
Okay. So let's go to the next slide. Okay, so the bottom formation occurs when it inverts and goes the other direction. So the number 1 and the number 3 will be support, and the number 2 will be resistance. So the bottom of the chart is going to be the number 1. And when the number 1 forms and the market changes direction to the upside, it will go up until it forms number 2. And a number 2 is formed when it reaches resistance and the market changes and goes back towards the number 1. If it fails to make a new number 1, then of course it will form a number 3. Okay. Which is basically what this slide says. The number 2 is.
Are you all right to keep going, Johnny?
Pardon?
I say, are you all right to keep going, or you want me or Barbara?
I'll take a break. Go ahead.
Okay. Well, Barbara, will you take us through this one?
Yes, sir. So this is the bottom formation. In the bottom formation.
Can you get closer to your mic, Barb? You're real low.
How about now? Can you hear me better?
Yes.
Okay, so this is considered to be a bottom formation. The lowest price on the chart is the number 1 right here. Has a little half moon above it to signify this is the lowest price on the chart. So the bottom formation makes what's known as higher highs and higher lows. In other words, you're going up the steps. You're following price is moving upward. So here is going to be your level of support, the number 1 and the number 3. Price travels up to make what's known as a number 2, which is a level of resistance. So what happens is it trades back down, but it does not go past the number 1. It makes what's known as a number 3, your second level of support. And it does this continuously. So when the number 3 is formed and it does not trade below the number 1, it is a number 3. It then trades back up past, it tests this number 2 right here. It trades above it to make what's known as a new number 2. That means the next level of resistance must be higher than the previous one. That makes it what's known as a higher high because it went higher than this first higher high. it trades back down to make another number 3. But sometimes you can have multiple number 2s. You have multiple number 2s and multiple number 3s. It's not guaranteed that it's always going to make that number 2 or number 3, as you can see. So here's another number 2. It traded back down, made a new number 3, traded back up again, higher high, made another number 2. Traded back down, see this number 3, higher low. It's lower than the number 2, but it's higher than the previous number 3. That's what makes it a number 3. This number 2 is higher than the previous number 2. It trades back up again, makes a new number 2, higher high than the previous number 2. Trades back down, makes a number 3, higher low, lower still than the number 2, but higher than the previous number 3. And it does this continuously until it does what's known as breaking the trend line. These are trend lines. That's another lesson we're going to get into, but these are known as trend lines. Now here, it makes a new number 1. This is your highest price on the chart. There's a little half moon right here. I've drawn over it so you can't see it. So now it's done what? It's changed directions in price. And you have what's known as the top formation, the first formation that Mr. Johnny was just talking to us about. And does the same thing, trades back down, 2, 3, 2, 3, all the way down. And it does this continuously. And you see here down to the bottom, it did what? It changed directions in price. It does this continuously, repeatedly, over and over again. And we've already learned about the 50%. So it's making its 50% over and over again in the market. But this is known as the bottom formation, making higher highs, the number 2s, and making higher lows, the number 3s. The number 1 and the number 3 are levels of support. That's considered to be your floor. And the number 2s are a level of resistance. Those are considered to be your ceilings. This is your formation, which is your support and resistance levels on the chart. So it's just places where price is having trouble trading through. So if you notice, let me clear the drawing. If you notice, it made a number 2, price didn't want to go no higher. So it bounced back down, it fell back down, it made a number 3. It said, oh, I don't want to go no lower. It stopped right there. It went back up, made another number 2. So I don't want to go any higher. It dropped back down. It does that over and over again. That's your formation, whether it be top or bottom. All right, Delvin, you want to add anything?
I did what you said it, so I ain't have to, but yeah, excellent.
Can I say something?
Mm-hmm.
Because I know someone has a question like, well, why doesn't price want to go any higher or want to go any lower?
Exactly.
I can hear that question out there, like, why? Okay, so you have to remember, you have buyers and sellers in the market. People are buying contracts and selling contracts all day, practically all night. And so when the buyers are in control, where they're buying more contracts than the sellers are selling their contracts, you're getting higher highs, which are the number 2s. And then the market gets to the point where the sellers are in control and they're selling contracts, and that's the predominance of what's going on in the market. And then the market goes down to a number 3. And so you have number 3s being formed, and it's fluctuating back and forth like that between the buyers and the sellers. So depending on who's controlling the market at any given time with buying or selling contracts, that's how the market price structure is moving and how we're making money. I just wanted to say that real quick.
Thank you.
Also want you to know that this
Thank you.
applies to all markets, whether it's the stock market or Forex or crypto, it all applies to
Yes.
to all the same market, all the markets.
Yes.
Yes, it does. This works in every market. All right.
Brother Melba, you want to cover the sideways channel or you want me to?
No, you can go ahead and cover sideways channel. Mhm.
Okay. Those three formations that we talked about. The 1-2-3 top formation, the 1-2-3 bottom formation, and the sideways channel. Out of those three formations, in my opinion, this one, the sideways channel, is the easiest of the three to recognize on the chart. So we watching for a 1, 2, and a 3 when it comes to the top and when it comes to the bottom. But when we're talking about the sideways channel, this looks different on the chart. And I feel, in my opinion, it's the easiest one out of the three to recognize. But where the sideways channel occurs on the chart is when prices fail to go up or down, making those 2s and 3s that Johnny and Barbara talked about. When the market's failing to do that, that's how we start to see what's known as a sideways channel, because the market trades horizontally, and when that happens, it's not trading up or down, it's trading sideways. And this is what's known to some as the market's consolidating. Well, what it really tells us is that there's low volatility. That's what that tells us. The market's not volatile right now. It's trading in a sideways channel, which means lower volatility at that time. Okay? That's what I really want you to understand about this sideways channel. And I said this is the easiest to recognize. So, Barbara, right here, you have a sideways channel. When it comes to this sideways channel, Barbara, talk to me. Do this happen on does this happen on the chart a lot? Is this something that happens a lot?
Yes, sir. It does happen a lot.
It happens a whole lot on it.
Yes.
Yeah, and and I'm asking you that to ask you this. So we talked about prices going up and prices come down. So we can have an opportunity to make money even when the market's trading sideways, right?
Exactly.
So even when it's not going up and down, it's still an opportunity for us to make money. And this is what this channel is for us. It's a sideways channel. And this is still an opportunity that we can take advantage of. Even though the market's not going up and it's not going down, it's trading horizontal in a sideways direction on the chart. And we still can take advantage of it. It's my favorite out of the three. And just because it's not going up, just because it's not going down, don't mean that we still don't have an opportunity to take advantage of. Okay. Well, I can't see the screen. I don't know what I did here to mine. Uh, finish this slide for me.
Okay, so this is 3-month SOFR, June 24. So it started out over here in the far left as a top formation, traveled down, and then it went in a sideways channel. And price just bounced inside of these two trend lines going sideways. So the good thing about sideways channels is this right here. So this is a sideways channel right here where price traveled, but you have what's known as breakouts. At some point, it's going to break out of its sideways channel. And sometimes it can stay in a sideways channel for weeks, for months, very long time. But most of the time when it breaks out, it travels in that direction for about the same length of time that it stayed in its sideways channel. Doesn't always do that, but it does that a lot. That is an indication for you who's entered that trade about how long to stay in that trade. As you see right here, it traded to the upside, broke out, traded to the upside. If you look at it, it's about the same length of time here that it was in the sideways channel. And so it made another top formation, went into a downtrend, traded back down again. So that's a sideways channel. So that's why Delvin was saying it's primarily that the easiest for him, for anyone to really trade, because you just follow the trend. You just follow the direction of price. And they're fun to trade too. They're very fun to trade. So
And
so once
Barbara, I
you
want to,
learn that,
and Barbara, let me add something right here because I know we talked about the top formation and the bottom formation, and when I said that the market is that means that the volatility is low at that time. I want to make sure people understand what I mean by that. So when we have these bars that move on the chart, or candles, whichever you prefer to use when you have your chart, you can use the bars or you can use the candles. But when you see the candles or the bars on the chart, I'm referring to the length of those candles, the length of those bars. When you see those long bars or long candles, that means volatility. That means that the market's moving and it's moving. Those bars indicates and tells you in which how it's moving. If it's moving, slow or is it moving fast? That's what I mean about the volatility. So when I see a sideways channel, most of the time those bars are not going to be as long as the market will be when it's moving in a real volatile way. It'll be shorter bars and candles. But can you go back to that previous slide that you had up with the sideways channel? And can we clear it so everybody can see this channel down here at the bottom? Clear your drawing. Thank you. So do you see how short these bars are on the chart right here in the sideways channel? You don't see no long big movement in the channel because the market's not trading real volatile right then at that time. And Barbara mentioned and talked about the market's going to break out of that at some point. And as long as it's trading like this, I always use an analogy to explain when the market's trading like this, it means that no one's watching this market. Nobody's watching. And I don't take that literally. Yeah, there are people watching it. My point is that it's not trading heavily with the volatility. Okay. And I love seeing this type of thing happen on the chart because it tells me there's an opportunity for me to take advantage of. This market at some point, like Barbara said, it's going to break out of this sideways channel. And I like to be at home when it does. Like Barbara said, it's fun when you trade these channels because it's going to either break out to the upside or it's going to either break out of that channel to the downside. But what's so exciting about it is that we have a strategy where we can be in place to catch it no matter which direction it decides to break out of it and go in. We at home. We there waiting. And it's exciting because we can be on board whichever way it comes out of that channel. We right there waiting on it. And that's why it's my favorite out of the three, because I love how I can catch this market no matter which way it breaks out this channel. So that's what I wanted to just jump in and say, Barbara, about the fact that that volatility, when I mentioned that I was referring to the length of the bars that you see on the chart. Okay. Go ahead, Barbara.
These are gaps on the chart. We also love gaps. So if you're wondering why does a chart have a gap on it? A gap occurs on the chart when price closes at one price and the market opens up at another price, leaving what's known as a gap on the chart. Charts do not like gaps. They tend to go back and close those gaps. Now, we're going to talk about how it goes back to close it. Every bar or candle is a day, a trading day in the market. So it cannot go back to that exact day. So we're going to see that on the next slide. And it may take a long time for gaps to close. Some markets, they're quick about closing them. And then some markets may take years or months or years before they close them. So this is an example of gaps on the chart. As you see right here, this is a gap. The market closed and opened up at a different price. Now this is about maybe April 22nd or so, April 22nd or so when this happened. This was one day in the market. But if you look right here at this candle right here, this long green candle, this is when it closed the gap. So it traded down and closed this space right here. This is probably about maybe April 25th or so, April 24th or 25th on a different day and time in the market. So always remember that it can't go back to this day. Here's another gap right here. If you look way over here at this candle, way in July, it traded down, it closed the gap that it originally made over here in the month of June. Same thing here, another gap up here at the number 1. But if you look at this new number 1 green bar, it traded, closed the gap. Still in the month of July, but on a totally different day, almost at the end of the month. So sometimes they close them fast and sometimes they don't. So it's an opportunity for you that's in the market. If you know that that price could go there, that's an opportunity for you. But that's a gap on the chart, but it's not going to fill it on the same day. So as you see, it traded back down on different days, different times, and closed the gap.
So Barbara, are you saying that there's going to be a space on the chart where there's no bar and it's going to leave a gap on the chart where at some point in the future, at a later date, the market's going to trade when it's filling the gap, it's actually trading back through that price range. And that's how it fills the gap. Is that what you're saying?
Yes, that's exactly what I'm saying. It trades back through that price range over here, like to the far left, and it closed the gap. But this was maybe about July 3rd or so, but it closed it maybe July 28th. It traded back and closed it. That's exactly what I'm saying. And this happens repeatedly, but it doesn't always happen. Sometimes it takes months, sometimes it takes years before it trades back to that place or gets an opportunity to go back and close it at a different day and time. So it's not that it does, there's no guaranteed 100% that it's gonna even close the gap, but a lot of times, oftentimes it does. So we see that repeatedly in the market. So here's the net, let me clear this out. Here's another example. This is a good example. This is Bitcoin. This chart is full of gaps all over. These are little gaps. There's no bars here, little gaps. Right here, there's gaps. But as you can see, there's one right here. As you can see, there's gaps down here. Not a lot of volatility, but all of them have not been closed. This one right here haven't been closed, but this is an older chart, so by now it may have. But as you can see, there's a gap here. If you look here, it closed it because this bar came all the way down on a different day and close this gap in this price range over here way in March. This happened in August. So that's a good example. But there's a gap here as well, and price hadn't got there. So that lets you know that sometimes it takes a long time for it to close, and sometimes they do and sometimes they don't. But it's an opportunity, especially when it's near your 50%. And we've already learned about 50% retracement. So a lot of times, if it's anywhere near your 50%, most of the time you can consider that gap to be closed. It's going to go to that 50% and it's going to recognize they want to close that gap, because charts does not like gaps. So that's an opportunity for you that's in the market. Once you get that.
Hey, Robert, if it's all right with you, I wanna go to a present situation, while we on this, cause,
Yes.
some people, some people kept asking me why I kept feeling as if Bitcoin would go back to 80,000. Bitcoin's at 108,000, 109,000. Why you think it's going back to 80? And it's because of the subject that we're covering right now. There was a gap, a huge gap on the chart that I felt it could go back and cover. But I wanna make sure I say something Dr. Melba always reminds us all the time. Out of all the markets that we watch and trade, crypto is the one that doesn't seem to care much about gaps like the others do. So Dr. Melba always reminds us, man, it takes time for them gaps to fill in crypto. Right, Dr. Mel?
Yes, that's the personality of the cryptos.
Yeah. And I kept saying, I keep my eye on Bitcoin because of these gaps that I see. And we know markets retrace when they get into these bull run and bear run. But the gap was the indication to me that we could retrace back to that level, that area. Now, I want to look at the Bitcoin chart to show you what it is that we're talking about. And we can go to either the Bitcoin futures or the micro futures and walk us through how to get to it, Barbara.
Okay. So I Googled barchart.com, our go-to platform. This is where we go, all things futures and commodities. If you see here on this second row says futures, I'm gonna click there, and I've logged out of my account. So I click here, and Bitcoin is considered a currency. So I'm gonna click on the commodities grouping for currencies. And it's going to give me all of the currencies where we're looking at Bitcoin. This Bitcoin Micro, April 2025, volume is 18,252. So we want that one. That's the most recent trading contract month, so which is April. So we're going to go to that one.
And where we going now, Barbara?
So I'm going to click on it, and we're going to pick out April, I believe. So we look at April 25, BAG 25. Open interest is 25,921. Volume is 18,991. So we want this month. The most recent traded has the highest open interest and volume. So I'm going to click it. So there's over 18,000 people in this market currently, and they have a total of 25,000 contracts. That's what that means. So it's a lot of people trading Bitcoin right now.
Anybody want to guess which way they're playing it? I bet most of them.
Okay, this is our contract specifications page. This is our go-to page. We want to know about Bitcoin. So we went through this on our bar chart lesson.
Yeah,
So
can
we're
you,
gonna click,
can you go to
say that,
full?
Mr. Okay. Here we go.
All right. So on this particular chart, we can see where the market, remember I said the market went up to 100,000. What was it, 108, 109? Where did we go? Somewhere like that, right? Okay.
Yes, we did.
Yep.
Yeah, and when we made that run up, the market left a gap on the chart, and it was around the 80,000 range, price range. And are you able to see that gap? Find that gap, Barbara? That was on the
85.
chart. It was around that range.
It's right here. 80,
Okay.
about 85, yeah.
And we had this gap on the chart, and I kept looking at the fact that the market kept selling off, and it was making several attempts to go back toward where the gap was, but after many tries, it kept failing, and it would go back up, and then eventually the market traded down to that gap and filled it, and this is what we're talking about. At some point, the market could go back and fill the gap that was on the chart. Like Barbara said, we can't go back in time. Each one of those bars or candles represents a day that the market was trading. And we need to know that that's what each bar, each candle represents, a day of trading. So we can't go back to that actual space, that area where the gap is, but we can come back in future. We can go and trade through that same price range, meaning that if the gap was at 80,000, the market can come back and trade at 80,000 at some point, and it would fill the gap that was left on the chart. And that's what happened in this Bitcoin. So I wanted to show you what we were talking about on the slide just a few minutes ago, what happened in the Bitcoin market. It went back to fill that gap. Barbara made the point that that is something that doesn't always happen, but oftentimes it does. Because like she pointed out, charts don't like gaps
Can I
for
say
whatever
something
reason.
about gaps?
Absolutely.
So one of the lessons I also learned about gaps is you have to remember where the gap is a range of a price that the market did not experience. It just skipped over that price. And so if you have set a trade to enter the market and it happens to be in a gap area, that trade will not get filled and you will not get into that trade because Mr. Wright and we were trading, I think it was Bitcoin or Ethereum together. And where he entered the market, it got filled. But where I wanted to enter the market turned out to be a gap and I didn't get filled. He took off with all of his profits and I was still waiting for the market to fill my order. It never did. I never got into the trade and I missed the opportunity. So I just wanted you guys to know that these gaps are important in two ways. Yes, it's an opportunity because you know that the market's going to come back and fill the gap and you can gain profits by being in the market when it does that and planning for it. But on the other end, also, your order may not get filled when you're getting in or even out of the market if it happens to be the price that you place that you want to get in or out of the market happens to be in a gap area because the market never experienced that price. That's what a gap means. And so you have to remember you're trading price structures. The prices are going up and prices are going down. and you're trading the difference between the market going up and down in price structure. And so always remember that. Don't feel like you did anything wrong because you cannot control the market. We get what the market gives us. And so if you see that you put in an order to be filled and it doesn't get filled, chances are it's because the price that you put in to get filled at, there probably was a gap there and the market never experienced that price, so it couldn't fill what it never experienced or recognized.
And we were trying to trade that together, right?
Yes, we were.
Excellent, excellent. So
This is
we
the chart.
we're
here.
gonna cover this stuff multiple times. But Johnny, you want to speak on this? You want to say anything?
This is a great chart right here. And I wanted to go back and talk about our point again. January the 24th. Can you find that mark on January 24th? Okay. What happened on January 24th? There was an election. I mean, there was, President Trump became president, right? Okay. Now, so my question is, based on our lesson today, if you would have heard nothing about the news, what do we see here at this point in the chart? Do we see a 1, 2, 3? So I don't care what kind of rhetoric you hear people talking about. The chart told us exactly what was going to happen after the election, or after everything went through. We got a 1, 2, 3 top, and we started a downtrend. So if you mark up this chart with a 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, you'll see. Now, granted, at 108, there's a big old gap there, isn't there? Okay, January, 1st of January. Huge gap. Did it cover? Yes, it did. All right. Now, what are we going to look for from here? We're looking for a down market until such time it forms a 1, 2, 3 bottom. So pretty simple without knowing, anything. Have we talked about 50% retracement yet?
Yes.
Okay. So I go, I know Dr. Melba and Barbara are keen on this. So if we're in a down market now, or a bear market or downtrend, how far do we expect this to go? Oh, and by the way, there's another gap that's formed at the tail end of this chart. Okay. So we got a new gap. So how far do we think this market's going to go down? At least 50% retracement.
At least. That's right.
So that gives us a point to where we want to start, taking interest. Now, my question is, why do we think, I asked the question, which, I bet if we go back to contract specs and look and see how many people are long and how many people are short interests, And this goes back to some of the earlier training we did.
Fascinating, Johnny. Fascinating.
Barbara, can you go get the contract specs on that contract?
Yeah, the price overview.
Yeah. I'm just curious. I haven't looked at it, but look, go scroll down just a bit. Right here. All right. The number of longs, 410 contracts. The number of shorts, 391. But you're going to see that number, people are short in the market now. Look at the what's the next one? Large speculators. The bottom one on the left. How many long contracts are there versus short contracts? Can you help me out, Barbara? I can't see.
You mean leverage funds, long, short?
Yes.
7,717 long and 13,124 short.
Yeah. You're starting to see that invert where people are starting to get out of the long side and go into the short side. This goes back to what Delvin talked about at the very start of the call. People are positioning themselves for the market to continue to go down. Those people that are short the market are going to make money as it goes down. But at some point in time, all those shorts are going to have to do what to get out of their contracts? They're going to
have to buy, Johnny.
They're going to have to buy.
Okay.
Excellent, Johnny. Excellent. And this also gives you a visual of what Dr. Melville was talking about when she talked about the buyers and sellers. I hope this helps with understanding what she was talking about. So, great point. Excellent. Excellent. We needed to just look at a live current situation. And that's why I wanted to go to the Bitcoin chart to give a more recent, up-to-date example of that gap forming on the chart and then being filled. And then we got a chance to see that there's even some new gaps that have formed on the chart. But you're going to get some more extensive training when it comes to the gap. But just know the gaps are very, very important to understand because they happen a lot. So when you see a gap on the chart, it's not a glitch on the chart. And like Dr. Melville said, this is an area where the price just didn't trade. Okay. So if you finish, Johnny, we'll go back to the slide. Like, did you want to point out anything else?
No, the only thing Theo had a question when we were talking about the 1, 2, 3 top and 1, 2, 3 bottom. And I didn't know if we wanted to entertain that question real quick.
Hey, Johnny, it was actually answered already.
Okay, great.
Thank you, sir.
Okay. Excellent. And yeah, I hope y'all have a bunch of questions for us when we get through talking about core makers and gaps. Because this is stuff we want to understand. This is a big part of the system that we use when we trade. So yeah, get them questions together. So what we had on the slide, Barbara, we
we have our video.
We was in gaps. Did we finish gaps? Did we have another slide with
finished
gaps? So
gap. We
we didn't have no
finished
more
gap.
charts about it. Well, if we didn't, I wanted to mention something about gap. I didn't know if we had another chart that was going to talk about it, but I wanted to make sure I say this. Sometimes the market closes and it closes at a certain price. Okay. Let's say the market closed at 10. And then the market opens back up the next day or the next evening, and it opens at 15. So it closed at 10, but when it opened back up on the next section, it opened up at 15 instead of opening back up where it closed at, which was 10. So since we have a difference in price from where the market closed and where it's opening back up again, this leaves the gap on the chart. This is what Dr. Melville meant when she said the market didn't experience trading through that price. Closed at 10, then opened up again at the next session, and it opened at 15 instead of opening up and trading up to 15. It opened up at 15. So it didn't trade up to 15. It was at 15 when it opened. And this leaves gaps on the chart. Okay? This is how this happens on the chart. I want us to understand that. And a lot of times markets open up at a different price than where they closed at. And what's making the market do that? Why didn't it open at 10 like it closed at 10? Remember when Johnny was just talking about those buyers and sellers and breaking that down? A lot of that comes into play. We can have a market close at a certain price, and depending on the movement of the market, the volatility of the market, depending on the buyers and the sellers that's taking place, all this could play a part in why the market opens and closes at a different price. So this is why I wanted to make sure we understood that. The market closes at one price and opens at a different price. And now we have a gap on the chart. All right. So Barbara, you said we had finished chart slides on gaps, and now we have a
We're up
video
to
that
the
you want.
video.
All right.
Yes.
So y'all be patient with us. We may be going over our time today. I told you we had a lot to go over.
Hi everyone, this is Eric from Traders Helping Traders with this week's Tricks of the Trade. This week I want to talk to you about the ever humble but super powerful 1-2-3 formation. This is such a basic support and resistance formation that we have a tendency to overlook it. But it is one of the most reliable signals and one of the most powerful reversal signals. And I'm going to show you in a minute how you can use it as a continuation signal out there. All right, so what is a 1-2-3 formation? 1-2-3 formations were made popular by Ken Roberts. He traded the 1-2-3 formation and the channel formation. That was pretty much the whole essence of his course. But he was very strict with his 1-2-3 formation. I'm going to show you a little modification on the 1-2-3. But essentially, the 1-2-3 is when the market makes a new low, that's the number 1 point, goes up, makes a new point of resistance, that's the number 2 point, and then the number 3 point occurs when the market comes back down and challenges the support on the number 1 point. Now that would be what is called a 1-2-3 bottom formation. And let me just play this forward a little bit so that you can see what the 3 point's going to look like. All right. Here we have the 1 point, which is our low. Here we have our 2 point, which is our high. And then here we have our 3 point, which is new support. And remember, support is our red-green bar combination. It came back down here. It did not exceed the 1 point. And therefore, we have a 1, 2, 3 formation. The way the 1, 2, 3 formation is traded, I'm just trying to get rid of the lines here so that you can see it a little better. Maybe I can't do that. Okay. The way the 1, 2, 3 formation is traded is that the signal confirms when the market trades above the number 2 point. Now, us support and resistance traders know that we can get in a little bit earlier, especially if this number 3 point showing support has a reasonable sized bar attached to it. This particular instance, the size of the bar forming the number 3 point and the entry above the number 2 point, pretty much the same. So the way it works is we would use our number 2 point as our entry. And in this instance, we would go long if the market breaks the number 2 point. And you can see a few days later it did, and we would be long this market. Traditionally, the exit stops go all the way back down here below the support point. Now, that would depend a little bit on your own current situation. Obviously, the further back you can leave the stops, the better for your trade, because it will enable you to ride out some market swings. But I have been known to leave stops as close as a day or two behind a trailing stop. We're just going to play this forward. And you can see that in this particular instance, we got a pretty nice little run out of it. Now, what I want to show you, and I don't know why that line is there, but we'll get rid of that. What I want to show you is that you can also use this as a continuation pattern. So let's say, for instance, you didn't see the original 1, 2, 3. Now, the pattern is going to repeat itself so long as it is forming. In this instance, we're in an uptrend, so we're looking for it to form higher resistance and higher support. Remember, that's our basic definition of an uptrend from a support and resistance viewpoint. So long as the market continues to form higher resistance and higher support, we will continue to look for opportunities to buy. All right, so here we have an instance now where the market has essentially made another 1, 2, 3 formation, but this time the number 1 point is down here. We have our number 2 point, and we're going to be on the lookout for our number 3. So let's play this forward. Let's see where the number 3 comes in. Aha. Okay, that's looking a little bit like support. So now we have our 1, 2, 3 formation repeating itself. And what we can do, I'm going to make there. That'll be easier to see. What we can do is we have new support here. If you're going to be more aggressive on this trade, you can enter above the support. So in this particular instance, you would enter above here, being the high of this bar, and we could cover the trade below the number 3 point. Now, this should be familiar to most of you because I do this a lot. I wait for the market to give us new resistance, come back down, show us support, and then I'll put in a buy order. Now, if you're following a secondary indicator like momentum or RSI or something, then you'll be looking for it to confirm that we have indeed a shift in momentum, and that will help make it a little bit easier to buy or will increase the probability of your trade. But even without that, this is a very valid buy signal. You can also trade the 1, 2, 3 again in the traditional format and not buy until the market trades above the number 2 point. That's entirely up to you. Entering above the number 2 point makes for a stronger signal in most cases. But of course, you also have the opportunity to profit, sometimes considerably, between the support formed by the number 3 point and the resistance by the number 2 point. Okay. Well, our number 3 point is still holding, and right now it looks like we could make this trade even a little bit tighter here. We have, if I back this up one day, we have new support here, right, with our red-green bar combination. Okay, now we are, hold on. Okay, I made us sweat for a few days, but it looks like it finally let us in. It's laboring. Oh my goodness. Come on. There we go, finally. Okay, I'm just playing this forward. Now, here we would have actually crossed our number 2 point. So you could have entered long here as well. But what I want you to see is that the pattern is going to repeat itself yet again. So you had actually multiple instances where you could have reused the 1, 2, 3. You could have reused it here. You could have gone 1, 2, 3. You could have gone like this. 1, 2, 3. And if you were really sharp, you probably could have caught this one too. 1, 2, 3. So you can see that not only is it a reversal pattern, but it also gives you an opportunity to enter a trade that is already trending. And once again, we have, at the moment, we have our 1 point down here. Looks like we have a possible 2 point. Yes, we definitely have a 2 point. So we have our 1, our 2, and now we're going to be on the lookout for our 3. Oh, something happened here. Did you catch this? What just happened? Remember what the definition of our uptrend was? We have to see the market make higher resistance and higher support. But look at what happened here. All of a sudden, the market has broken through our old support area. So now we might actually be looking at a reversal of our 1, 2, 3 bottom formation, and we might be seeing the opposite happen, a 1, 2, 3 topping formation, where the market makes a new high or a high, comes back down, makes new support, and now we're going to look for it to challenge this high, the number 1 high, and then fail. And sometimes you have to be really on the ball. Okay, now that looks like it's a 1, 2, 3 formation. This is a 1, 2, 3 formation, but it will not confirm a 1, 2, 3 until it has technically broken the number 2 point. Once again, you do have resistance here with our green-red bar combination, and you could look to sell below the number 3 point. But the safer trade is to wait for the market to actually to confirm. Okay, so far so good. Oh, struggling. Okay, and in this particular instance, if you had sold here the number 3 point, we would have been stopped out. Now, one thing I want to bring to your attention as well is even if you see a 1, 2, 3 formation like this, and you caught it the wrong way, another signal is to sell or buy the break of the number 1 point. And why would that be? Well, that's because the number 1 point is a very significant area of support or resistance. So in this particular instance here, if we had seen the 1, 2, 3 like this, you could have bought the market as it broke through the number 1 point. If back here you had seen a breakout here below the number 1 point, you could have sold here, even though it was relatively short-lived. It isn't always. Many years ago, when gold was falling instead of reaching new record highs, I saw a 1, 2, 3 formation in gold almost every month or so, and I kept looking for an opportunity to buy, only to see gold prices continue lower and lower and lower. Don't ask me why, but it took me a long time to figure out that I could actually sell a failure of the number 1 point, and I made a lot of money doing that when the market gave me a 1, 2, 3 setup and never completed, but actually went in the opposite direction. So those are the three things you can do with a 1, 2, 3 formation. You can look for the 1, 2, 3 tops and bottoms. You can look for the intermediate 1, 2, 3s as an opportunity to trade the market with the trend. And you can buy or sell a failure of the number 1 point and that's a valid signal as well. So keep an eye on those 1, 2, 3s. They're very powerful, very simple, and very profitable. And that's this week's Tricks of the Trade.
Thank you, Barbara. I always enjoy that video. And I want to make sure I always do like I guess, done in the past. I like to make sure we point out a couple of things when we watch this video. We just went over formation, and if it's your first time seeing this, it could be a little bit much for you from the first time, but I want you to know, like you've been hearing us say over and over and over, the more you look at charts, the easier this is going to be. And at the same time, I want you to understand, the more you watch these formations, the easier this stuff is going to be. So my point I want to point out from this video is that when we went over formations, we looked at the fact that well, let me say this. You heard him talk about the fact that he wanted to show you something new when it came to using the formation called the continuation. So over time, some people have made modifications to how they trade the 1, 2, 3 formations. Okay. You heard him point out that Ken Roberts, who made these formations popular, was very strict in how he traded and used the 1, 2, 3. And thinking about it, I guess I will have to admit I am too. We use the 1, 2, 3 in the same similar fashion that Ken Roberts did when he used and traded and taught the 1, 2, 3 formation, meaning we use the 1, 2, 3 in this manner, where we just showed you. In this manner we use, there's only one number 1 on the chart. All right? Meaning that there's only going to be one number 1 when it comes to the 1, 2, 3 top. There's only one number 1 when it comes to the 1, 2, 3 bottom. In this video, you may have seen several continuations of reusing the 1, 2, 3. The way we use it, we have one number 1, but we have multiple 2s and 3s, like you saw in the video. We just don't have multiple number 1s in the way we use and trade with the 1, 2, 3. Don't want anybody to be confused, but it still shows us how the system works and how the 1, 2, 3s are traded. That's why we like to use this video, because it gives another perspective. It gives a good visual of how the 1, 2, 3 works. But just remember, the reason we only went over one number 1 in our illustration, because that's how we traded from the traditional way of how it was traded. Some people have modified over time, and there's nothing wrong with that. And you may decide to do that yourself, but I just wanted to make sure you understood why you saw multiple number 1s in the video, but you didn't see that when we went over the formations on the slides. Anything you want to add, Johnny, before we get into Q&A? Barbara, did we finish up everything?
Yes, you did this at the beginning. You talked about buying, I believe you did, buying low. I don't think you got into the selling high though, but you talked about a part of it. Part of this, you talked about the buying.
Did we have this in this lesson?
Yes.
Because I know we probably went out time already.
Yeah, we have. But we could go over it next week if you want to. Just go to.
I didn't want to. I don't want to keep extending the lessons to you all because I know we want to complete them within a certain time frame. And I think we were on track to complete the lessons right before the retreat. But we've been had so much stuff we've been going over and covering. We've had to make one of the lessons 2 parts, and we may have to do this one the same. Johnny pointed out earlier in the call, there's one particular subject or topic that we have to spend a lot of time on. And that's the one, that slide you might just see, which was the topic I talked about at the beginning, about the fact that we can make money when prices go down. And if it's all right with everybody, since we've went our duration, if we use another call to make it part 2 of lesson 6, and we'll get into covering how that works. All right. Johnny, did you want to mention it or talk about anything, Barbara, Dr. Level, about the video?
Yes, sir. On the video, it makes it very important. And this is what I was showing on the Bitcoin chart. Just because you missed the high, I mean, look, folks, we're not going to be able to pick the high, and we're not going to be able to pick the low. But the chart's going to tell us when it is. And just because you miss the first 1, 2, 3, whether it's up or down or whatever, does not mean that you have to wait for the next one. The market will continue to give you signals whether or not you can continue to play the, as we call it, the 2-3, to get back into the market and experience the trend. And, like I said, the day that the market hit the high, again, that was the first of the year. It came back and challenged that number 1. And when it challenged that number 1, that was when it failed, that was our opportunity to get back into the market and continue the downtrend. So don't, just because we don't pick the high or pick the low doesn't mean that we can't still profit from the trend. And that was an important part on the film at the end, or on the video at the end, that he was trying to make, that when the failure of the number 1 exists, it's an opportunity to get back in or to continue on with that trend.
Absolutely, Johnny. All right, man, thanks. We had some good information that we went over today. And again, I know it was a lot of information, but it was some very important information. So the fact that we have an opportunity to go back and go over that again, look at that again, take advantage of that. Also, too, we talk about the fact that you heard us say that, charts, they tell a story. Charts, they're speaking to you. They talk to you. And that's kind of what you just saw, what the chart is saying. It's telling you what's going on, like Johnny was pointing out. Whether you follow all the fundamental stuff or not, the chart is telling you exactly what is going on. It's telling you a story. And once you learn how to read those charts, you'll be able to understand the story that the chart is telling you. And I want to make sure we clear on this one. Don't feel any way about the fact that you looking at the chart and you don't see what we may see. At some point, we were you. Every one of us were you. We couldn't see absolutely nothing when we looked at the chart too. So over time, you'll be able to see the chart the same way. All right. Let's get into some Q&A. So we won't be on here much longer, but I hope we can get some good Q&A going. Any comments or questions anyone has, now is the The call is now open for any questions or